Hello everyone, I'm Tom with Stock Navigators, and today I'm going to talk about the danger of using margin when swing trading. Today, if I would like to ask you two questions. Are you new to trading or investing, or do you have a margin pocket account? If you answer yes to either one or both questions, you are in danger of losing your money and fast. Have you heard about 90-90-90 rule? This rule states that 90% of the new traders lose 90% of their account balance within the first 90 days. This is a statistical fact. Financial institutions and hedge funds love this and they call this a dumb money. Bluntly speaking, your broker is not your friend either because they bring in dumb money to feed the hungry investment banks. Margin is a vehicle to the pocket used to accelerate this process. They causing the investor to lose their money even faster. So before we dive deeper, let's start with some education. What is a margin account? A margin account is a type of brokerage account in which the broker lends cash to their customer to purchase stocks or other financial products. This is naturally just like a loan, which is collateralized by the security purchased and the customer cash. Further, a periodic interest on the amount borrowed and fees typically apply because customers are investing borrowed money. They are using leverage which can magnify profits and losses as well. Brokers often push margin on the new traders who often agree to it because the approved process is so easy. New traders must at all costs avoid falling into this trap. So let's talk about the disadvantage of the margin account. We will use the analogy where your brokers hands you a bazooka with absolutely no training. In this scenario, the trader often shoots himself on the foot with it. In the same way, margin can significantly magnify losses. When price goes below the price which the position will open, the broker will typically issue a margin call, which requires the customer to deposit certain amount of funds to liquidate a position in their asset to cover for the loss for the previous day. The broker will do it for them, and they are good at finding the worst time to sell your share. We will explain it in the real example further in next presentation. So, what are some advantages of the margin? I'm going to use a bazooka analogy also, where now the trader has been properly trained to correctly use the powerful weapon. With margin, the trader can short stock, however, not all stock qualify, and we will discuss this later as well. Margin can magnify profits, which is why traders get greedy and agree to it. A properly trained professional trader knows how to use margin when day trading only, because he or she knows it is highly risky to hold position overnight. Remember certain pattern daily trading rules, common referred to as a PDT rule, can interfere with the number of trades. If the customer does not comply, then you can make for account less than $25,000. So, what are some potential outcomes of going long with margin? Scenario number one. Let's say if you nail the entry to the stick and the price gap up and does not go below the entry price, then you are in the money right away. This is very hard to do for even the most proficient trader who have to account for normal volatility in their stop loss. Scenario number two is the more frequently seen scenarios when price go down even slightly as part of normal volatility. You can be issued a margin call the next day. Your broker expect you to deposit more cash to meet their requirement, or they can will start liquidate your asset at the worst possible time. This is what happens most of the time. If you decide to hold your position and margin overnight, if the trade goes in the broker favor, They may allow you to hold a position and continue to run your account and ultimately sell at the bottom. This works exactly the same way with a short position. We will discuss danger of short stock in more detail later. One example, new trader went long in a major sell zone using 100% margin. First, let's take a look at the real trade. A new trader took between January to February 2020. The trade were long position with shares purchased for a company called Epsilon Therapeutics. The ticker symbol is EFPR. And we are looking at the max monthly chart. They are they are a U.S. rock company located in Michigan, which has recently obtained much anticipated FDA approval for a novel rock. He may like new traders, open a margin account, and use all his cash and full margin potential to open a long position in January with the share bought at the $74 per share. Because at that time the analysts were expecting the stock price to double, he failed to realize from a technical analysis point of view he was in a major sell zone. He was also trading without a stop loss and had no risk management in play. The price went to the sell zone show and got rejected immediately and started to fall quickly. He will issue a margin call next day, but he ignored it, hoping the price would turn around any day. The broker did not start liquidating his asset until the price got under $46 2 full weeks later. This is because it was going against the broker's interest to liquidate the share early. However, for the new trader, the damage was done and he had ran 69% of his account, which amounted to a $19,000 loss in only 2 weeks. So that you can see poor risk management and were the major contributor to his business loss. Now, let's talk about shorting stock and their risk. First, let's get some education. What does the shorting stock mean? Shorting a stock is when the trader borrows share from a broker to sell at the high price, which helps to buy back at a low price. The difference in price is the trader profit. Mechanically, this works just like going long, except the process is more complicated. So what does it mean? Going short was previously listed as one advantage of trading with a margin account, except there is a caveat. Broker typically subcategorize stock and security in 2 subcategories. The first category is the ETP, which stands for easy to borrow. This is where traders can easily borrow shares from the broker to open short position. The second category is STP, which stands for hard to borrow. These stocks are typically not available to short unless the account owner have a special STP margin account, typically offered for the account over $100,000. We have observed brokers often categorize bullish stocks at the ETPs and bearish stocks at the STP. This means brokers frequently allow traders to short a bullish stock. This is a suicide trade. Now, let's continue to build on the same symbol of the ticker symbol EFPR. We have been monitoring how the broker categorize stock like EFPR and found that when the price is bullish or in the way up, they will allow traders to borrow less margin because they know that the probability of the trader's success on going long is high. Conversely, like in the short trade previous show, when the stock turned bearish, the broker increased margin allowed to go long. At the same time, the category will change from ETP to STP, such that the broker no longer allow traders to short this stock, which now we call bearish. In summary, this means that the broker are okay with trader shorting a bullish stock and going long for a bearish stock. This is a suicide trade. As Stock Navigator, we will teach students how to find stock to go long in this, because there's always something going up in every market condition. For new trader, this is a significant less risk approach than, say, shorting any given stock, because the broker cannot mess with your trade. This is such a valuable lesson for any trader considering margin account or considering shorting stocks, that we turn it into the important case study to teach students at the Stock Navigators trading school so that they can easily recognize and avoid them. What can new traders to do increase their chance of success? Always start with open an individual pocket cash account, no margin, at least until you become a proficient trader. You may ask, what is a cash account and how does it work? A cash individual pocket account is an account where the customer deposits cash to use it to buy stock or securities. It is one of the simplest pocket products out there, which is easy to understand for new traders. What are some advantages of a cash account? The biggest advantage is the broker cannot interfere with your trade. You can buy the share with your cash, and they are now your property for an indefinitely period of time. Only you decide when to sell it or add more to your portfolio. Another huge advantage of modern-day investing platform is you can trade stock commission-free with most corporate account right now. So make sure that you do your research before you selecting the trader platform or brokerage. What are some disadvantages? With a cash account, the trader cannot short stock or security, which is not recommended for new trader anyway. New trader can significantly reduce their risk this way. So, in conclusion, without the right education, the stock market can be a dangerous place. Poor risk management is the number one reason why new traders fail in the market, and using margin cause most traders to lose their money even faster. The margin, I reckon, a trader read, which is the number two reason why new traders fail in the stock market, because it ruins your risk management. The expert trader course offered by Stock Navigator will teach you how to properly handle the risk management technique so that you can be a successful trader or investor. We train, mentor, and empower our students to operate 100% independently to navigate the market with confidence. I welcome you to join our community Success Trader. Take a next step toward taking control of your financial future, so you can watch the free webinar, follow the link below, and let us know if you have any questions. Again, thank you for watching and have a good day. And remember, click like, subscribe, and get notified when we have a new video posted. Again, thank you for watching and have a good day.